Assalamualaikum warahmatullahi wabarakatuh. Hello everyone, my name is Adelina Safitri. My NPM is 244110009. I'm from Management Class 24A. So today, for 10 minutes right, we will discuss about material market risk management. So this is one of the most important aspects of business and financial management for management risk. So here Uh, understanding risk is essential because every organization operates in an environment that is constantly changing. So these changes can affect profitability, competitiveness, and even the long-term survival of business. Therefore, companies need effective strategies to identify, assess, and manage market risk. So first, let us understand the meaning of market risk. So market risk is refers to the possibility of financial losses resulting from changes in market condition. So these changes may involve fluctuations in interest rates, exchange rates, stock prices, commodity prices, and inflation levels. And overall, economic conditions, unlike operational risk, which originate from internal business activities, so market risks generally arise from external factors that organization cannot fully control. And for example, if an Indonesia companies imports raw materials from the United States or US, a sudden increase in the value of the US dollar against the Indonesian rupiah can increase production costs significantly. As a result, the company may experience lower profit margins. This is a simple example of market risk. So there are several major types of market risk. The first type is interest rate risk. This occurs when changes in interest rates affect borrowing costs, investment values, or company earnings. So business that really heavily on loans may face higher expenses when interest rates increase. So the second type is currency risk, also known as foreign exchange risk. Companies involved in international trade are particularly exposed to this risk because fluctuation in rates can affect revenues, expenses, and profitability. So the third type is equity risk. So this refers to the risk associated with changes in stock price. Investors and companies holding stocks may experience gains or losses depending on market performance. So the fourth type is commodity risk. So business that depend on commodities such as oil, gas, coffee, wheat, or metals may suffer financial losses due to sudden price changes. For example, rising fuel prices can significantly increase transportation and production costs. So another important type is economic risk. Economic recessions, inflation, political instability, or global crisis can reduce consumer spending and negatively affect business performance. So market risk has become increasingly important due to globalization. Today, economies are interconnected, meaning that events occurring in one country can quickly influence markets around the world. A financial crisis, political conflict, or major policy change in one nation can create uncertainty and affect businesses globally. So, understanding the relationship between risk and return is also crucial. In market risk management, generally investment with higher potential return involve greater levels of risk. Business leaders and investors must balance desire for profit with their ability to tolerate risk. Taking excessive risk may produce high return in favorable conditions, but it can also lead to substantial losses when market conditions deteriorate. deteriorate. Now, uh, let us discuss why market risk management is important. Effective market risk management helps organizations protect their assets and maintain financial stability. Without proper risk management, business may face unexpected losses that threaten their operations. Investors, customers, and stakeholders also tend to trust organizations that demonstrate strong risk management practices. So, market risk management supports better decision making by identifying and evaluating potential threats. Managers can make informed decisions regarding investment, financing expansion plans, and pricing strategies. So, the process of market risk management generally consists of four major steps. The first step is risk identification. So, organization must identify potential market factors that could affect their financial performance. This include monitoring exchange rates, interest rates, and commodity prices, inflation, and economic trends. The second step is risk assessment. After identifying risk, companies evaluate the likelihood of each risk occurring and estimate its potential impact. This allows managers to prioritize risk and allocate resources efficiently. The third step, is risk mitigation. So organization develop strategies to reduce, control, or transfer risk. These strategies may involve diversification, hedging, insurance, or financial control. So the fourth step is monitoring and review. Since market conditions change continuously, risk management is an ongoing process. Company must regularly monitor market developments and adjust their strategies accordingly. So several techniques are commonly used in market risk management. One is popular technique is diversification. So diversification involves spreading investments across different industries, regions, and or asset classes. This reduces dependence on a single source of revenue and minimize potential losses. Another important technique is hedging. Hedging uses financial instruments such as future contracts, options, and swap to protect against unfavorable market movements. For example, an exporter may use currency hedging to reduce the impact of exchange rate fluctuations. So organizations also use analysis and stress testing. These methods evaluate how a business would perform under various economic conditions, including extreme scenarios such as financial crisis, recessions, or market crisis. Another important measurement tool is value at risk or VAR. VAR estimates the maximum potential loss the company or investment portfolio may experience within a specific period under normal market conditions. While it cannot predict every possible outcome, VAR helps managers to understand their level of exposure to risks. So, companies also conduct a scientific analysis which examines how changes in specific variables affect financial performance. For example, a company may analyze how a 10% increase in fuel prices would impact its profitability. So, that's it about my material. Thank you so much for watching. Don't forget to like and subscribe. Hope this material helps you a lot. Also, thank you so much. Assalamualaikum warahmatullahi wabarakatuh.